The S&P 500 rallied for the fourth straight day, the first time we've had a four-day winning streak since the presidential elections 2016. So it's been a while since we've had a good multiple-day streak here. We've actually gone up 6 days out of the last 7, and then you would say, 8 days out of the last 10. So off of that Christmas Eve, actually the day after Christmas. Oh yeah, Christmas Eve. Low point that we had. So the market's bouncing. Are we done in the short term? That's what I'm going to break down in today's video, as well as a trade idea from a really, really hot sector, which is reversing its fortunes from being one of the worst sectors. So let's go ahead and get started. Today is Wednesday, January the 9th, 2019. This is the market outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast indicator on the S&P 500. And you can see the intermediate line is making its way back towards 50. Now, again, typically there's a hiccup at the chart's midpoint, the green line, what I'm talking about here. So don't just think that we're just headed up now to 3,000 all in one fell swoop here. More likely we'll get a little bit of a hiccup as the S&P itself gets towards that 2,600 area. Multiple layers of resistance in the short term there. So that's, short-term sentiment is still bullish, so it's not like any pullback's going to derail what we've got going on here, or send us reeling again back to new lows. Even though we could get a divergent low point, we could get a low around 2,400. We could drop, almost a couple hundred points here, and just be normal. So now, that won't be the case. Everybody will think the world's ending, but that's not the reality. But, again, it doesn't mean, again, this low point, this last near-term low point we have right here where my cursor is, that's kind of the area to watch and any pullback we may get in the short term. Remember, the near-term rallies, when the blue line crosses above 50, typically last 7 to 12 days, but that's shortened to more like 3 to 5 days when the green line is below 50. So we'll keep that in mind. Again, and that would also suggest meeting up with some resistance here after the near-term line being up above 50. What now? 3 days, almost 4. So we're kind of in that range now of where we can say, okay, there's probably going to be some type of pullback here to bring it back down. All right, if market sentiment's rising, you can see it starting to pull back up again, coming off of all these oversold clusters that we've had. Look at the Dow Jones Industrial Average, and you can see also coming up against that moving average. Bullish short-term sentiment, increasingly bullish, still weak, but increasingly bullish intermediate posture. Rising market sentiment. Same thing here on the NASDAQ. It's actually gone through its moving average, unlike the Dow and the S&P. And then the Russell 2000 also has gone up through its moving average. Again, getting closer to that chart midpoint with very strong short-term sentiment. So very common patterns here. Again, we've been really, really bullish over the last few days. Again, I would expect that. I don't expect the longer runs. In fact, the Russell never did pull back. So this is all one big rally that the Russell 2000s had. So we've been above 50 now on the blue line for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So that's a long time without a pullback. So again, it would not be surprising if we meet up with some resistance in this area across all these major indexes, considering how bullish we've been up to this point. Again, market sentiment's rising, not quite above 20. That's what made these clusters so significant, and again also raises the odds of a decent return going forward from here over the short term. So next year or two, some decent return. So again, going back to the S&P 500. You tend to get these sharp bounces off of the original surge low point. When this was the original surge back here, we got that sharp rally, and then we went sideways for a while. But then we went to new lows with a new surge, and now we're having the initial bounce back. And it's rare for that initial bounce back to turn into a bullish trend. It's more likely to get us up towards resistance, get a new low point, whether it's a new... I would doubt we'll get lower lows in this one, but we could. I would venture to guess at the worst we'll probably get a low point around 2,400, so right around the same area or a little bit higher, and then we'll have a successive bounce like we saw before. We'll have it again here. Okay, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our Market Scholars logo right here, and then hit the red subscribe button that pops out. Also, hit the thumbs up icon that's down below the video. That tells us two things. Number one, it tells us you got something out of it. Number two, you want us to do the video again tomorrow. So if that's the case, one click right now you can do right below the video, hit that thumbs up icon. Also down below, comment on what stood out to you. What did you get out of tonight's video? What was one thing, hopefully or more, that you learned or got out of it? Let me know down at the bottom. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen up there. Click on that link to subscribe. Follow me on Twitter for more content like this throughout the day. And join our Market Outlook community that we created on Facebook. Also, while you're watching our video, you can do that here on our blog. There's a few links on this page. You can click on this heart. That opens up your Twitter account. You can like it from there. Tonight's Market Outlook tweet. Also, you can click on this image. Takes you to your Facebook page where you can click on the like button there as well. Again, clicking on the likes tells us you want us to do the video again. If that's not the case, then you don't have to click on anything. As a reminder, and then of course you see our schedule of classes coming up here tomorrow, 2 classes tomorrow, and then our technical analysis class on Friday. Remember, you can discuss the market outlook with other market scholars in our forums. To participate in those forums, and this one in particular, the free forum, you can do by subscribing for free, clicking on this image in the top right corner. Alright, back to the charts. You can see the weekly chart here. Now remember, we still got 2 more days left this week to go, but you can see a pretty good return this week so far. But you also see that we're hitting up against that 50-day moving average, which is typically when you're coming off of an extreme low below the 200-day moving average in blue. The first area of resistance you hit is the orange, the 50-day moving average, which typically leads to more downside and more weakness in the short term, a new low point around this area, and then a rally up higher. We'll see if that ends up playing out to be the case again. You take a look at the 3 green arrow charts. You can see we're really close to finally getting that third red arrow on the moving average. Now you remember, it's more important not just that we get the green arrow, but that the green line turns, this line, which is the 6-week moving average, turns green. When it turns green, that means we're above it and it's rising. You can see we had 1 day of that back here. The rest of it's been orange red, which means we're below a falling moving average, or yellow, either above a falling moving average or below a rising moving average, which is what we had briefly right there. So here we're still red, so we're still below a falling moving average heading into tomorrow's result. And you can see when it turns green, that's when you have a good trend, a good bullish trend going. So we don't have that yet. We look at these indicators in the 2-line versions. You can see we have broken up above the 8 and the 17. The 8 is close to closing above its 17. Now, usually when you've got the reversal, usually you'll get the 8 crossing the 17 at about the same time that both lines cross the 30. So we're not close to that yet, which again means probably some short-term weakness until until these things kind of moderate a little bit. The MACD is approaching 0, which when it's coming off extreme lows, typically hiccups around 0, a little plus or minus a little bit there. So we'll keep our eyes peeled for that. And then finally, so we'll take a look at the intraday charts, and you can see that we did have a really small range. So the ranges are getting much smaller. It was a higher high and a higher low, and we got some strength late in the day with the FOMC minutes. Weakness early when the crude oil inventories came out. But we did bounce off of that, back up above yesterday's high point, and finished with a really tight range. You can see the volume here on this intraday chart really starting to taper off. So what does that look like on the daily chart? Here, let me pull up SPY on this chart. And you can see, down to 95 million. So very low volume. The trading range today at 2.72 points. So very small ranges, and the effect that that's going to have is going to start bringing these the ATR down, the relative ATR back down below 2%. Getting below 1% is when that bullish trend really entrenches. So we still got some while to go before that. And then, of course, 95 million is down here. So that's going to start bringing that line. And again, these will start coming down before the low point, before the new bullish trend starts. See, the bullish trend didn't start till right here, if you recall, May 4th. That's when the bullish trend started. And see how the down at the bottom, the moving average for volume and the ATR were both coming down from their highs, well off their surge highs. So we've got some time. So what that means is when we get that next drop, the next area of weakness, it will be a slower move than what we saw here at the end of December, right around that options expiration date. All right, let's take a look now at volatility. So let's bring the volatility chart up here. Just note this one here. All right, so volatility continues to come down, and we are getting close to a support level for volatility at that 95% mark here. That there tends to be some support in the short term, means that we might bounce back up into around 1. I don't expect us to get back above 105, at least for too long. I expect us to bounce up here, get around 1 before we make a run towards 90%. We'll find some support again. Breaking through 90%, just like breaking through 1% on the relative ATR, that's the sign that the bullish trend has started and is entrenched, and we're good to go for the normal expected time frames for bullish trends. So to summarize, the market is getting a little long right now, coming off of this sharp kind of V bottom, heading up towards resistance, and multiple technical indicators suggesting that we might see some short-term weakness here. Again, it might be relatively big weakness simply because of how high the volatility index is and how big the moves have been. We might retest or come close to this 2400 low point, but the reality is it will just be similar to the bounces and successive drops that we've seen in the past. And we are looking like we might be close to at least the first peak coming after this surge. So what do you think? Do you agree with that assessment? Do you disagree? Let me know. There's that link popping out right there on the top right corner of your screen. Click on that link, then answer the poll. Either agree or disagree. If you click disagree at the top, scroll to the bottom and let me know what you're seeing that would suggest otherwise. All right, now let's take a look at what's driving the price action. The biggest mover today was crude oil, up over 5%. Crude oil continues again, it was kind of an underrated cause for the declines that we saw in Q4 last year. It's really been bouncing up sharply as stocks have been bouncing up as well. You see emerging markets also really taking off, almost 2% gains. Both developed and emerging outpacing U.S. stocks. Small cap stocks continuing to show relative strength against the S&P 500. That's a good sign. Weakness in long-term bonds, that's not surprising. And weakness in the dollar. That's been something we've been watching to see. What happens to the dollar, and a weak dollar can have a positive impact on equities across the board, but in particular will have positive impact on international stocks, whether it's developed markets, you can see making their way back up towards the 50-day moving average, a little bit above it, or even emerging markets, which are even not much further above their 50-day moving average. So, they've been beaten up the most. They were showing a lot more weakness a lot earlier than the S&P, and now these international areas are starting to show some really decent strength. You look at crude oil. Crude oil has made its way back towards its 50-day moving average. We'll see if what it does here at this important area. You look at crude oil, gold, which was also makes its moves depending upon what happens with the dollar, and you can see it's getting a golden cross here with its 50-day crossing above the 200. So really good strong rally in gold based on the weakness in the dollar. So that's having its implications. This we've been looking for a long time here for the dollar to show some weakness. It's gotten up to the Fibonacci retracement zone. It even made it run past the 50% retracement line here at the end of the year. Now starting to pull back and now testing its 200-day moving average. Let's take a quick glance at the yields here, the 10-year yield, having broken below its 200-day moving average. You can see this week bouncing up off of some lows after hitting Fibonacci support at that 50% area and dropping on an intra-week basis down to this 26 area. So it's starting to show a little bit of a bounce. If you look at the yield curve, which is not updated for today, but the yield curve had been bouncing. It's pulled back a little bit, and again, the yield curve at the bottom, the spread, is measuring the gap between the black and the purple lines. So you can see as the purple line bounces up again, there you can see it better there. As it's bouncing up again, it's bouncing up at a faster rate than the black line. If you look at the calendar here, the only thing really on the calendar today, besides the inventory report, which produced some initial weakness in crude oil, at least in the stock market, right? The crude oil eventually stayed up really, really high today. But the FOMC minutes, and the FOMC minutes, the minutes of the meeting were actually a lot more dovish than the press conference that came immediately after the meeting ended. So interesting to see the discrepancy between how hawkish Powell was, Fed Chairman Powell was, that caused that big, fluffy decline that we saw in late December. That's been immediately reversed, right? How relatively hawkish he was then compared to the minutes of that meeting on the same day. Behind the scenes minutes, right? So we got the press conference in front of the cameras. Behind the scenes, they were a lot more dovish, and that's what we saw. And so as a result, rate hike odds, which had jumped up to 21% or 23% to get a one rate hike, so almost 25% before today, has dropped back down to about 10%. So very, very little chances of getting a rate hike. And you can see the odds of a rate cut jumped up a little bit. They had really fallen, but they've jumped up. But really the odds of staying right where we're at for most of 2019 is the highest. So pretty good chance there's neither a rate hike nor a rate cut. Most likely not going to get a rate cut anyway. That's if we're getting a rate cut this year, then things have gotten bad. But if the markets are bullish the rest of the year, we'll see what the odds for a rate hike come into play, and right now it's very, very minimal, very, very low odds that we'll get any movement at all in the interest rates over the next 12 months, at least by the end of this year. I mentioned the strength that we're getting in a lot of these international areas. You can see up here the S&P is up 0.4%, but everything else showing really strong gains. Brazil continuing its relative strength to 0.5%. France up 1.5%, UK up 1%, Germany up 1.75%, so Italy up 1.25%, South Korea, they're all above their moving averages now. The S&P's right there. Some of them up a lot more than others, and some of them have rising green lines. Italy is moving averages turned up. India had already had, Brazil already had turned up. So some of these others are yellow now, so we're above falling moving averages, but we're above them. So starting to get some color changes on those moving averages. And again, I would expect, if we are going to be bullish this year, I would expect with the falling dollar, which usually happens after the Fed stops their rate hike cycle, you'll get outperformance in these international areas. Doesn't mean the S&P will go down, but it just means that as it goes up, you'll probably get better performance in emerging markets especially. Now let's take a look at how the sectors are performing, and again you can see the S&P over here on the left. Some of these sectors, the sectors at the top of the sector ranking not doing as well. Utilities down, staples are down. I remember the S&P is up 0.4%. Real estate's down, so they're all lagging behind, all below the moving averages. The ones here at the bottom, which have been the worst performers, are all the best performers. So energy up 1.5%, technology up 1.25%, industrials, discretionary up 0.5%, healthcare. And so you can see where the relative strength is. It's all coming from the bottom, and the relative weakness is all coming from the top, which is typical when you're coming off of extremely oversold conditions like this, at least until you hit some of this resistance. And again, you would expect, with the dollar being weak, you would expect the industrials and energy and materials to outperform in that environment, and they've got a lot of room to make up because of their, really big, and this is their 3-month returns over here. You can see over the last 3 months, they've had the biggest losses. Energy down almost 20% still over 3 months, even with this bounce. And industrials also down, even with this bounce, down 15% over the last 3 months. So still relatively big declines that they're just now starting to get out from under. If you take a look at it here on this chart, remember crude oil is up 5% today, so at least the USO was up 5%, the ETF that tracks it. So energy stocks are up 1.5%, doing very well, and there's technology. Again, you would expect these areas, which have been beaten up during the decline, to do well on the bounces. And then there's your safe havens, actually showing some declines today. Again, they held up. If you recall, from the high point from last October the 3rd, the high point that we hit before the decline started, if you recall, they actually had held their gains really well. And were, had small losses to small gains. In fact, it wasn't until that Christmas Eve sell-off, before the Christmas Eve sell-off, they were all pretty close to showing gains. And then they, see energy and technology dropping the most. They're bouncing the most. So just is what you would expect to see. All right, one of those stocks in the energy sector that had a little bit of a breakout move today is ConocoPhillips. You can see breaking above 65, which... right below 65, there's multiple areas where this blue line is. We're probably right about 64 and a quarter. So there was some resistance there, but you can also see this volume area right around 65.35. That was the biggest volume node, which acts as a pretty decent resistance level, and we pretty much busted through that today. So a good sign from a technical perspective. For that, if you look at like the market forecast chart for ConocoPhillips, you can see its intermediate lines rising above 50, so it's different than the market. You also see it's above a rising moving average now, so it's yellow based on yesterday. It'll be green starting tomorrow, so we have a dark green with a green line. That's usually a good sign. You'll have a green line tomorrow. It's usually a good sign for trend reversals. You look at the 3 green arrow chart for ConocoPhillips, and you see we got 3 green arrows now, above average volume, but not quite the 2-line versions of it, but decent volume there. If you look, not exactly 1.5 times, excuse me. If you look at the 2-line versions of these lines, MACD crossing above 0, stochastics getting to high levels. The 8-day is crossing above the 17-day. They're both really close to crossing over the 30. It usually occurs at similar levels. So you can kind of see the breakout there. There is earnings coming up here before February expiration, so we do have to keep that in mind. And then finally the DMI for ConocoPhillips. So we'll pull this up, and then we'll also pull up the other DMI indicators that we usually look at as well. So you can see the histogram is finally turned because we're getting a crossover here above, just barely, but we're getting a crossover as evidenced by the histogram. With this line here rising up above. See, the last crossover we had over here, it was falling. So a little bit of a different scenario than what we're getting right now. So positive DMI indicators, things looking like there's opportunity. Going forward for the stock. So we can, again, without being too aggressively bullish, because we're expecting short-term weakness, at least from a broad market perspective. So we have to keep that, and plus you have earnings coming up, so we'll have to relook at selling a 65 put and buying the 62.5. That's where that blue line comes from, is the break even for that trade. There's your break even price there. and the odds of success. And keep in mind that normally this, depending upon where you get filled in, so relatively widespread, not too wide, but relatively wide. It's got a $176 maximum loss, where we try to keep our losses to about that $72 area, right? So we don't want to lose more than what we're trying to get, and that $74 loss is going to be, in this, we'll buy the purple line. It's going to be around 62, so we got a few more bucks to go, and that's going to move higher. And remember, we're only going to go for a half, about $37 out of that 74, and that number is going to move closer to where we're at as time passes. So we'll see if we can't get 50% of our maximum gain quickly, and then be able to move on to something else. Alright, so that wraps us up for today, and now I want to hear from you. There's a link popping out up there in the top right corner of your screen that will take you to our forums, questions, comments, what we talked about today, questions or comments on anything I didn't talk about today. But we can be able to continue this conversation with other market scholars in the forums. Make sure you're also replying to each other instead of just waiting for me there. But I'd love to hear your thoughts. Again, thank you very much for watching. Remember, if you haven't already, subscribe to the YouTube channel. Click that thumbs up icon. Let us know that you want us to do this video again. And also comment. Be sure to comment down below. Follow me on Twitter for more content like this in between videos. And then join our community on our website, marketscholars.com, for free. But you can also join our Facebook community that we created for those that watch the video. Again, have a great rest of your evening, everybody, and we'll see you all tomorrow.